Alison, this is a perfect job in expectations management, isn't it, from the C-suite of Citi and JP Morgan?
It's actually remarkable how close the fixed income trading is coming into estimates, just given how volatile that business is and how tough it is to say. I would say at first glance, one of the more positive things for Citi is equities, much better than expected. So keep in mind that doesn't mean much to the quarter because the equities business is much smaller for them than their fixed income. But I think it's important and strategically, one of the things that they talked about at their investor day was the fact that they want to grow that business to be, they want to be in the top 5. They've made progress. They're number 7. That's up from number 9. And one of the reasons why that's very important is as we go into 2018, January 3rd, MiFID II rules are going to take effect. There is a sense that a lot of people are going to implement that globally. And there is a sense that a lot of managers have talked about, we're going to use 4 to 6 of the top tier and then a long tail of specialists. And so just given that, I think there's a strategic imperative for Citi to gain share, something they've talked about at their investor day, and it looks like they're making some progress. So going to want to hear a little bit more detail about what's happening there behind the numbers.
Alison, let's do a couple of things. Of course, we need to get through what happened with fixed income trading. Then we need to talk about loan growth. They're kind of the dominant stories for the banks. For fixed income trading, a 16% decline from last year for Citigroup. And for anyone that's following this on the Bloomberg, you can do this on the Top Live Go function, TLIV Go, and you can follow the Top Live blog for the earnings from Wall Street throughout the day here on Bloomberg. The story for me, Alison, is these banks are delivering drops in trading revenue, fine. Jamie Dimon and the likes would say this is like obsessing over the weather. We can't do anything about this. Is that necessarily true?
Well, I do think we spend a lot of time talking about FICC around earnings, and the reason why is because that can be volatile quarter to quarter. So when you get a big surprise, you get a big disappointment. When you get a big swing, it's going to be in that line. You're not going to get that same kind of swing in loan growth, for example, because that's a book of business that grows. You saw a little bit of a slowdown at JP Morgan in terms of the growth rate, but you're just not going to get that volatility. But what is important, as I said, and that's one of the reasons why maybe I'm focusing on Citi's equities business, which is much smaller, not important to the quarter, probably didn't move the dial in terms of this quarter's earnings, but you do want to focus on what's happening longer term. And so when we look at the trading results, that's why we want to know not just what happened, but why it happened. One of the bigger picture stories in FICC is, Goldman, they've trailed. And again, if it's one quarter, it's just because of business mix, that's one thing. But if there are underlying issues, if there's trading performance issues, investors are going to want to look at that and look for that to be addressed because it is a significant revenue stream for the companies. Again, the quarters are backward looking, but investors are focused on what is the run rate, especially, it's meaningful to Citi, it's meaningful to Goldman.